Whitney, talk to us about why this shift, this pivot, is the right one at the right time.
Well, look, we basically think it's an incredible company that's encountering some short-term turbulence, and short-term may mean it lasts for a few quarters. We're not making any immediate call that things are going to suddenly get better, but that's, as a value investor, I look to buy great businesses when they temporarily fall out of favor, when I think the long-term economic characteristics and growth are still intact, and I think that's the case.
Okay, talk to us about the long-term growth, because that's what everyone's now questioning. The sudden jolt that this is a company that, yes, is still posting about 20% revenue growth, but isn't posting that sort of growth in daily active users. Why is the growth trajectory still a strong one from your perspective?
Right. Well, keep in mind that Meta is not just Facebook, which has slowed down dramatically, but Instagram and WhatsApp are still growing, and you still got 10% active user growth year over year in a quarter that was supposedly horrible. They also, the two drivers of Meta's revenue growth are, of course, number of users times the monetization per user. And in every part of the world, that also rose in the fourth quarter. So again, they're making the shift by Apple that makes ad targeting more difficult is sort of a one-time downward reset by about $10 billion this year. And they're making a big investment in the metaverse, which we actually think is sort of an interesting free call option that you're not paying for here. But let's keep in mind,
Aren't you paying for it? They've just paid $10 billion to invest in that part of the business.
Well, they're not paying $10 billion. They're investing a cost of $10 billion annually going forward. So that haircut earnings last year, for example, were 18% lower than they would have been had they not been making this big investment. So we look at the core business, which has some of the greatest economic characteristics of any business in the world. I'd say rivaling Alphabet's business. Right now you're paying less than 18 times this year's reset lower earnings estimates. And in fact, I was stunned to see famed short seller Jim Chanos tweeted that Meta is cheaper. The stock is cheaper than IBM, which is a notorious value trap. It's been a value trap I've been warning my readers about literally for more than 20 years, and the stock has been flat for 20 years.
Yeah, but to be fair to Arvind over at IBM, they've actually started to post the revenue growth that many had hoped to see from IBM. We're starting to see the cloud business take off because there's more business spending, but we haven't seen that sort of business spending coming into the advertising part of, for example, the whole plethora of Instagram and Facebook. And instead, what we're seeing is Mark Zuckerberg warning about competition. No question, competition is rising, and you can buy Facebook today at 11 times trailing 2021 EBITDA. IBM, for perspective, trades at 15.4 times trailing EBITDA. And IBM's got a bunch of net debt. Facebook is drowning in cash. It is one of those numbers is wrong. It is absolutely one of the most craziest things I have ever seen in the markets when IBM trades at 15 times EBITDA and Facebook trades at 11 times. One of those numbers is very wrong. I think IBM's probably overvalued, but I also believe Facebook/Meta is undervalued. Very briefly, from your perspective, you're also warning, you talked about IBM value trap. There's also traps, you think, in some of the more speculative parts of the market. Particularly, I'm looking at AMC and the like. You really don't like some of those stocks.
Yeah, well over a year ago, literally the day the meme stock bubble peaked, I published and sent out an email to my 140,000 readers calling the top of the meme stock bubble literally to the hour. Those stocks, I named 25 stocks. The leading two were GameStop and AMC. They're down an average. Those 25 stocks collectively are down an average of 50% in a plus 16 market. But again, exactly a month ago today, I named my top 10 stocks to top 12, excuse me. I call them the dirty dozen, the stocks to avoid for this year, the stocks that I would be shorting if I were still running a hedge fund. The three top stocks are Digital World Acquisition, the Trump SPAC, which is the only one that's actually gone up in the last month, making it an even stronger stock to avoid. And then my next two are GameStop and AMC,
which are down 70, 80% from their all-time highs when I nailed them a year ago, but still are overvalued. So, this is an interesting market.
Yes.
A lot of speculative stuff is pulled back, creating good opportunities to get into good companies, but there's still a lot of overvalued dreck out there. So it's, to being a long short investor like I am, lots of opportunities on both sides.